Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation. Shares for beginners. Weekend Watchlist.
G'day and welcome back to Shares for Beginners Weekend Watchlist, where we take a close look at an individual company that you may wish to consider for your watchlist. It's not a recommendation to buy, but a way for you to learn how Stockopedia screens for value. Joining me today is Chris Batchelor, and we're talking REA Group Limited, ASX code REA. How are you, Chris?
Yeah, very well, Phil, on this rather chilly morning.
That's why I'm so rugged up here.
Yeah.
Trying not to put the heater on and save some money.
Yeah.
So let's just have a quick look at the history of the REA Group. I mean, this was one of Australia's first internet.com companies, software as a service, whatever you want to kind of call it, isn't it?
Yeah, that's right. So they started out sort of mid-90s, just when we were all sort of getting our head around this concept of the internet, and put together a property portal for buying and selling property. They listed in 1999. At the time, all those types of stocks were booming, but only 2 years later, that whole .com thing went bust, and they lost 90% of their value more or less overnight.
So many of the newspapers at the time made an incredible amount of money by these classifieds and also property ads, weren't they?
Yeah, that's exactly right. And of course, our younger listeners would wonder what on earth you're talking about when you refer to the classifieds. But back in the day, the only way you could buy and sell, whether it was property or anything else, was to stick an ad in the newspaper, and people would buy the newspaper, see your ad, and give you a call.
But it was at this point that News Corp made the deal of the century, really.
Yeah, they did. So News Corp, pretty smart as it turned out. They stepped in and they bought 44% of the company at the time for only $2 million and threw in an extra $8 million of free advertising. Today, that stake would be worth around $7 billion. And in fact, News Corp have increased their stake in the business. They got as high as in the high 60s. They're now back down to 61.4%, but a very substantial shareholder in REA. And in fact, REA makes up a substantial portion of the total value of News Corp itself.
It's a pretty good deal to divert those rivers of gold from print to digital.
Yes, they obviously had some good foresight there and saw the way the world was going.
Yeah, from memory, I think it was also when the younger Murdochs all started to take positions in the company as well. I could be wrong about that, but I think that might have been the case. So we all know about realestate.com.au. What are the other divisions that contribute to the profit of this company?
Yeah, sure. So realestate.com.au is the largest component, the biggest profit driver for the business, but they do have a whole range of other components. Firstly, they have a commercial and developer business. They own realcommercial.com.au. They own flatmates.com.au, which is obviously sort of a rental and for looking for flatmates type of product. They have some other small businesses, media and data businesses that do about 100 million in revenue, and financial services business. They acquired the mortgage broker Mortgage Choice, which I'm sure many people are familiar with. They acquired that business in 2021. They also have their own loan products under the financial services banner. They're also expanding globally. Now, if you look at their presence in Australia, obviously they're the dominant player in the real estate listings business in Australia. But they also actually own 78% of REA India, and that's the number one property portal in India. And that's seen as a real growth opportunity for them. Also abroad, they own 20% of Move Inc., which is a USA-based business, and the other 80% of that business is owned by News Corp. And then they have a 17% interest in Property Guru, which is based in various Southeast Asian nations, again, as a property portal in those localities.
Many companies have tried to expand overseas. Are they expanding overseas, but hopefully doing it in a sensible manner?
Well, yeah, I mean, their early ventures into Asia weren't particularly successful, and they had some significant write-downs a number of years ago due to the amount of money they'd invested in Asia, which didn't materialize, didn't generate the profits that they expected. So hopefully they've learnt from those lessons. One thing they are doing, which is smart, is they're doing things in partnership with local businesses. So as I said, they own 78% of REA India, and that's increased over time. So they've sort of partnered with a firm that they were comfortable with, who knew that market, and have gradually built up their stake as they've got more comfortable in that market. So I think that's a smart way to go about it. Likewise, in the US, they own a portion of a US business rather than just trying to go in and do their own thing in the US. And even in Asia now, their interests through the Property Guru business, which is an Asian-focused business, as opposed to going in on their own. So yeah, they have had some missteps in their overseas expansion, but hopefully now things are more on track. And certainly this India venture seems to be going quite well.
An incredibly large market as well.
Exactly, yeah.
So, Chris, looking at the Stockopedia scores, it scores highly in Stockopedia, but it's another quality company with a pathetic value score.
Yeah, exactly. So this is what I term a quality compounder. So it's a very strong business, and it has been for a very long time. I mean, we mentioned those humble beginnings nearly 25 years ago, and you could have bought the shares for $1 or so. They're now 187 or $186. So for those who have been on the journey for a long while, it's been a really profitable investment. The thing with the value score is, of course, we're not the only ones to realize this. The market is well aware of how successful a business this has been and of those growth characteristics. And so what happens with businesses like this is the market looks at its historical growth. It looks at what it believes is its potential growth, and then it prices it accordingly. And so what we find is that REA tends to trade with a PE ratio of around the mid-40s. So that's a very high PE. It does pay a dividend, but it's quite a low dividend. Your yield's 1.2 sort of percent. So all those metrics that we use to measure value, they're all very high, and that's why you're getting a very low value score. It's a classic case of if you want to play, then you have to pay to play. You're not going to get this stock on the cheap unless there's something like another pandemic or GFC type scenario.
How volatile are the earnings? Is it closely tied to the strength of the property market at any given time?
There is a link, but I wouldn't say it's not as close as people kind of think. The general assumption is that if property is doing well, then REA will do well. There's some truth in that, but it's not the whole story. So the biggest driver of their revenue is listings, right? And that's not only the number of listings, but also the duration of those listings. And so a slower market can actually mean that properties are listed for longer, which means that customers are paying fees for longer. The other element of their revenue is yield. So how much can they charge for those listings? And we saw this, a real classic example of this in the previous financial year, 2023, where listings actually declined a bit. It was a bit of a softer market. There was a lot of uncertainty with interest rates rising and that sort of thing. However, that was offset by increased prices. They were able to increase their prices by significant amounts simply because they're such a dominant player in the industry. Effectively, what they are doing is getting people to upgrade to their more premium products, and that way people were paying a higher yield to advertise their properties on the platform. This was true of both of commercial as well as the residential market. And so whilst you had these declines in listings, you had this counteracting increase in revenue per listing. And so overall, the impact on revenue was not particularly, they did drop revenue a little bit in that year, but only a small amount compared to the actual fall off in listings.
And I believe there's a network effect in action here as well that's helping the revenue. Tell us about that.
Yeah, so some of these online businesses, and these guys are the real classic example of this, what they call a strong network advantage. So what that means is in order to attract listings to your site, you have to have lots of viewers. And if you have lots of listings, then you attract lots of viewers. So it kind of becomes a virtuous circle because people want to list on the site because they know lots of eyeballs will see their views. And people want to go to that site because they know that lots of properties will be listed there and they'll probably find what it is that they're looking for. So that gives them a real powerful moat and means that they can actually increase their prices at the same time as they're increasing their market share. And that's, a really unusual but powerful situation. They're also in a rather unique situation in where their business model enables them to actually use real estate agents as their distributors. So what happens is actually the vendor that pays for the ads, so the person selling the property, but the real estate agent effectively encourages the vendors to place an ad on realestate.com.au because that will give the vendor the best chance of selling the property. But from the real estate agent's point of view, they're not disincentivized by the price because they're not paying it, right? So they don't really care about the price. They just want the
they're also not allowed to charge a margin on that either, are they?
No, that's right. So, yeah, a study was done by REA Group, so bear that in mind. But nevertheless, their study found that homes that aren't listed on realestate.com.au actually sell for an average price of 4% less than those that are listed. That's a very compelling competitive advantage.
Are you picking shares on gut instinct? Buying on press tips or rumours? Do you struggle to find the time to keep up with the research and analysis that goes into evaluating potential stocks? Stockopedia are pleased to offer a special deal to listeners of this podcast, a 14-day free trial and a 10% discount on the first year of membership. Sign up now at y.stockopedia.com/SFB. There's no better time to access the most comprehensive, easy-to-use investing toolbox for DIY share investors. 10% off, 14-day free trial and a 30-day money-back guarantee. That's y.stockopedia.com/SFB. So the biggest competitor would be Domain. What's the size differential in comparison?
Yeah, I always find it amusing that in their slides, they always refer to themselves as, their metrics are average monthly visits are 5 times their nearest competitor, as if no one knows who that nearest competitor might be. But so there's one example, 5 times for monthly visits, 2.8 times for app users. Their market cap is 14 times Domain. Their revenue is 4 times. Their profit is 8 times. So they're a lot bigger. Domain is a good, successful business, but these guys are in a completely different league. They really are the market leader.
And revenue from advertising as well. What kind of component does that make up of the overall financial picture?
Yeah, it's pretty small. Yeah, as I mentioned, they have a media and data business, and that includes the advertising component. All of that together made up $100 million, which is out of like $1.5 billion.
So let's dig into the financials. What are they looking like?
Yeah, well, as you mentioned, the value score's very low, but countering that is a very high quality score and momentum score, giving us an overall stock rank of 71. So if we look at some of the more recent results, well, FY23 was a bit of a weaker year, and we've sort of touched on that, how the listings declined a bit during that year, but they've bounced back strongly in this year, and they released quarterly results, which is unusual for an Australian company, but because their parent company is a US company, News Corp, they are required to release quarterly results. So that gives you a bit more of an insight into how they're going. But just looking at the half-year results that were released in February, it showed a really good rebound and indeed extended their lead over Domain. So their revenue increased by 18% for the half, 17% for Australian revenue, and interestingly, 21% for Indian revenue. EBITDA, or their profit, was up by 22%, same for their net profit after tax. Worth noting, though, that their net profit after tax was up 22% on an underlying basis, but on a reported basis, it was actually down 37%. And that was due to an impairment in their investment in Property Guru of $120 million. You'll recall I mentioned that they haven't always been as successful as you would like in Asia. Well, there's another example. They've had to make yet another write-down of their investments into the Asian market. Now, they did
just before you go on about that, I just wanted to ask, just to clarify for people who don't understand the accounting practices, this figure that Property Guru represents in the revenue, it doesn't affect the revenue itself. This is just a write-down of the value of a company or the value of an investment that they've made in a particular company. Is that right? Just if you can clarify for listeners.
Yeah, particularly as it's only a relatively small investment at 17 or so %. That investment has declined in value. They've had to recognise that in their books, but it doesn't go to the revenue line, but it does hit the bottom line.
So it hits the net profit after tax line. Is that correct?
Yes,
okay.
That's
just getting
correct.
my head around the accounting that goes on with this.
So, I was just going to give a small update from the quarterly results. So, quarter 3 results, which came out in May. revenue up 24% when compared to the third quarter of the prior year. That's been driven by strong Australian residential and commercial yield, and also India, strong revenue growth in India. And the CEO commented that the Australian property market is really maintaining strong momentum. You're seeing a lot of seller confidence and a very healthy buyer demand. As we know, very strong immigration at the moment. We've all heard stories about the housing shortage and so forth. That's putting a lot of upward pressure on housing and prices, and that's positive for REA. Adding to that, about the more recent results, as mentioned, the quality score is very high, and that's because they're consistently able to grow the business over long periods of time. Revenue and EBITDA have been rising for the last 18 years, and they're forecast to continue doing so. ROE, the return on equity, is about 20%, which is a very high number. Likewise for the return on capital employed. Their operating margins in the 30s. So, these are very strong metrics for any business. So that's why they score really well on a quality perspective.
So what's the outlook going forward?
The CEO, as you might expect, is pretty bullish. He states that the environment is close to perfect as you would get for a business of theirs. A lot of this is due to as we mentioned, the strong population growth, surge in demand. Right now, analysts are forecasting earnings per share to increase by 23% for this financial year, and then another 20% in next financial year, along with solid revenue growth. There are some concerns. Of course, the issue of housing supply, whilst it pushes up prices and demand, it means in the long run that there will be less properties available to list. And as we discussed earlier, that's really the biggest driver of revenue for REA, particularly affects their commercial and their developer side of the business. They're already seeing a bit of a situation where less development projects are being advertised, less projects are being developed, which of course is contrary to what the governments are trying to achieve. They're trying to drive that side of things, the more affordable housing side of things. But the costs of housing, the costs of building these developments keep going up. And so that's working against the whole affordable housing story. The other big opportunity for them in the future is, of course, India. They're already the number one property portal in India, but it's a huge market with huge scale for growth. People talk about a total addressable market of something like $9 billion. Some analysts are forecasting compound annual growth of 33% all the way through to 2030. That may be overly optimistic, but the thing with a market like that, it doesn't have the penetration in terms of the online selling of the property. So there's potentially a really big opportunity there if they manage to capitalize on that.
Okay, Chris, any final thoughts on REA?
Yeah, well, as you can probably tell from the sentiment of this interview, it's a very strong business. Potentially that strength could become a bit of an issue. And it was interesting to note, it was only a small issue, but in March they attempted to take over a small business called Dynamic Methods. And Dynamic Methods make forms for real estate transactions. And that acquisition was knocked back by the ACCC, citing that they would have too much market power. So, once you become the dominant player in an industry, that can start to work against you to an extent where the ACCC are on high alert, keeping an eye on your activities.
Yeah, that is the problem with being an 800-pound gorilla in the room, I guess.
Exactly, yeah, that's right.
Okay, well, just before we finish off, can you remind listeners about the deal at the moment, the end of financial year sale for Stockopedia?
Yeah, absolutely. So we have a really attractive offer available at the moment for the end of the financial year. If you get in before the end of June and sign up for a free trial, you'll lock in, firstly, a discount on your subscription, on an annual subscription. So if you're looking to subscribe to the Australian market, that would be $495 as opposed to our normal $575. If you add additional markets, then there's greater discounts. And we're also including a copy of Roger Montgomery's best-selling book, Value Able, which is a really great tool for investors looking to get into the market. Roger's a very well-regarded media commentator, fund manager, and has written a great book, which I actually helped him with. I was one of the editors of that book way back in the day. So I encourage you to take this opportunity to have a look at Stockopedia, and right now is a good time to buy. We don't do many sales, so if you want to get it at a discounted price, this is the time.
Chris Batchelor, thanks very much for joining me again.
Thanks, Phil. Always a pleasure.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.